The selling continued last week as all 5 of the major markets fell again. The mounting weekly losses have created the longest consecutive stretch of red for the Dow Jones Industrial Average since June of 2011. This speaks to the idea that there's been a bit of an ebb and flow to the markets lately, as it was just in February that the index marked the longest consecutive stretch of gains since 1995. As of Friday's close, the month of May has seen a loss of around 4% for much of the developed markets. There have been even greater losses seen in both the technology-focused and emerging market segments, while the trade wars continue to play out. On Monday, the Commerce Department announced that it had granted Huawei a 90-day license to work with domestic technology providers to maintain existing services and provide users with security updates. This walks back the earlier hardline that prevented Google from providing software patches to Huawei phones that utilize their Android operating system. However, this concession only provided a short-term boost to the markets, as the S&P 500 traded back near unchanged for the week on Tuesday. In the end, the S&P 500 still gave back 1.17% for the week, as traders took protection ahead of the long holiday weekend. Historically, May has been a lackluster month for the S&P 500. While May has ended positive on average since 1950, the average monthly gains have only been about 0.25% prior to this year. This places May towards the bottom end of the monthly performance, and has added to the idea of seasonality, with the phrase "sell in May and go away and come back on St. Leger's Day." Summed up, this month has been dominated by headlines surrounding the US-China trade war after trade talks fell apart weeks ago. Now, Reuters reports that China may be targeting the supply of rare earth metals out of China as the next source of leverage against the US. These fears sent the technology sector down further last week, as the information technology sector was only outpaced by the drop in energy. Energy, meanwhile, was pulled lower by falling oil prices. In fact, last week, the S&P Crude Oil Index experienced the largest daily drop so far this year. Treasury yields also dropped again last week in a flight for safety. The 10-year closed at 2.32%, placing it 6 basis points below the effective Fed funds rate. It is rare when the 10-year yield falls below the effective Fed funds rate. The 2 prior lengthy spans of this occurrence took place in the early 2000s and again in 2006 and 2007. Both of these prior periods were marked with a rising Fed funds rate, as well as fresh all-time highs in the S&P 500. As the unofficial start of summer kicks off this week, market participants will continue to process this information ahead of the second estimate of first quarter GDP due out on Thursday.